So Salman bhai, with that, you are the master of your craft. Would love to hear from you. What's happening in the markets for 2024? A lot of people are again talking about recession, talking about the shapes of recession, L, V, W. I read somewhere it will be Nike sign, swish kind of a recession. So would love to hear from you. What should we expect in global markets next year, and also how should we think about investing, both from a personal perspective and I would love to hear from you any implications on what you how do you think the liquidity position in the markets would play into asset valuations, both for equities, emerging market equities, as in stocks in Pakistan, and secondly, also the venture capital space, so the high risk space, because what happens in the VC space in the US eventually flows to Pakistan. So with that, over to you. I think the format of these webinars are after you give us the outlook, I'll ask you a couple of questions, and then we'll open up the questions from audience, and please write your questions on chat, and then I'll read it to Dr. Salman. So Dr. Salman, over to you.
Perfect. Thank you very much, Ali, and thank you, Ale, for setting this up. A real pleasure. So I guess I can take a few minutes to, as you said, Ali, set up the outlook for next year, how we're thinking about it after a very eventful 2023, of course. I think I personally found 23 very tough, to be honest with you, from a macro perspective, because 2022 was a pure macro year. You saw inflation start to build up, central banks start to pivot. But 2023, obviously, the resilience of the US economy has been quite strong. Then we had obviously the geopolitical impacts still coming through with the latest conflict in the Middle East as well, and then some of the more medium-term, forces which are starting to take shape. And I think one thing is pretty clear that post-GFC era is potentially over in some significant respects. So let me start with for the next 12 months. So we basically this year around shared an outlook based on scenarios. So basically, because we thought that we need to be careful in terms of how we talk about it, because real investment process works on probabilities. And it's not like you set up an outlook and then go away for 12 months and then come back and see what happens. It's a more organic process of looking at data, looking at the calibration of policies, and starting to think about how markets may react. So over a 12-month horizon, we are still in the recession camp for the US. We think that the tightening has gone quite significantly into the system. It's taking its time to show up. But there are areas where we are seeing signs that this is potentially cycle will go into a cyclical recession. But that said, route towards a cyclical recession lies through soft landing, which is the view right now in the market, which is being embraced by the markets, and the Fed's potential pivot reinforces that. That said, the Fed has been making U-turns again right after 24 hours of that meeting. So it tells you that we are potentially near our inflection point, but at the same time, the certainty with which the policymakers are responding to it is low, because they themselves have been surprised by the resilience of, for example, the US economy to these very significant rate hikes. In Europe, economics has been much more clearer. We had significant tightening done by the ECB, and that has shown into the system, whereby you see a recession coming through, especially in Germany, and the pass-through of rates to the real economy has been faster because of the nature of the debt in the system. Whilst in the US, the delayed effect of fiscal has been quite strong, and has buffered the consumer sector or consumption sector, which is around 70% of the US economy. And then corporates, especially the large ones, have been the major beneficiaries of rate rises, because they've had locked-in rates for longer periods. So we can tell why that resilience came through, but we think those are temporary factors, and the transmission channel will start to become more stronger as we go further into 2024. But at the moment, we are of the view that soft landing can become even more stronger and will take time to dissipate because the underlying fundamentals are changing more slowly than the narratives are. So this has been a very narrative-driven market where narratives are dominating market action whilst the underlying fundamentals are changing much more slowly. But two things I want to highlight. Firstly, if you look at credit growth to the US economy, it is negative in real terms. So it's 3.7% year on year right now. And if you adjust for inflation, it's already negative. Some components of credit to the real economy have turned negative outright. In Europe, it's actually zero growth. So negative, quite significantly negative in real terms. So you can tell that that transmission channel is starting to work, and there are buffers in the system which have allowed this resilience to come through. But here we're looking at the behavior of the consumer, where consumption is still strong, but the usage of very high cost borrowing has shot up. So buy now, pay later, credit card loans, auto loan delinquencies, for example, have gone up are starting to go up quite significantly. So it's showing signs of vulnerability in the consumption space. Even though right now consumption is strong, we think it's being propped up by expensive means. And that means that, as we move forward into 2024, things will start to change. But there's no doubt that right now rates have peaked. Inflation has moderated, inflation and growth is moderating from above trend levels. So it looks like soft landing. A lot of our indicators are already consistent with soft landing, but we are of the view that this is not a constant reality, i.e. Labor market pressure will start to build up as we go further into 24, and like an average recession will show up. But the Fed's pivot or potential pivot right now is important because as we thought, they will not wait for inflation to go to 2% before signaling a potential shift in the policy. And that's because they want to avoid a balance sheet recession because debt is very, very high and real rates shooting up so significantly can run that risk that balance sheet starts to roll over into these very high rates and create a deleveraging cycle. So they are aware of that. And I think this pivot shows that they are willing to tolerate higher inflation. And so basically the next 10 years, you're likely to see higher average inflation. Not only because of monetary policy, but also because of deglobalization, because of decarbonization, which is going on, which requires investments and may create shortages, if you will. So there are multiple reasons why inflation may average higher, but this central bank's views are consistent with that. Interestingly, ECB and the Bank of England have remained hawkish and more focused on inflation dynamics. One can understand why Bank of England is doing that because inflation is structurally a bit higher in the UK because of Brexit and other things. But ECB was a bit more surprising because the economy is weaker than it is in the US. And if there is anything which requires some support is the European economy, especially if the fiscal side is also going to come under pressure in Germany. So that's a little bit on our outlook, which is basically soft landing now, cyclical recession later. Markets, especially the broader base market, has started to be helped by these seasonalities and the view that the Fed will start to become more supportive. But we think the labor market has turned. It will continue to slow down, and the lagged effects of these will start to turn this into a more average recession. That means the Fed may have to pivot, but it will have to pivot more dramatically than what the market pricing is, and maybe a bit later than what the market pricing is. So we're not in the March camp, and you can see some of the U-turns which are coming from the Fed already. That March may be too soon because the fundamentals are not changing that quickly. So It's 2024 is likely to be a transition year into a different phase of the cycle. Also, a setup for the next 10 years. There are years which define an era, and that potentially could be it, because inflation may stay with us. We have a lot of debt in the system that will require management. And then, of course, the most important factors, especially on the political side, you have two main elections, and of course, a very important US election. 2 billion people are going for elections next year. Most of them are, clear-cut results. Even in the UK, even if we get in October, November, Labour is likely to win. India, for example, where Modi government is likely to win. We'll see what happens in Pakistan, although one can assess where it is going in terms of the outcomes. But US elections is a true 50-50, and you can have very different outcomes both externally and internally in the US as a result of Trump presidency or Trump presidency 2.0. So 2025 may be very tricky, because if Trump comes in and does fiscal at a time when interest rates are higher, you can potentially have a UK type accident there. But that's not a 24 story. That's probably more of a 25 story. But it's an important year for politics. It's an important year for economics, where the question would be questions are, how much of that lagged fiscal has been used up, how much of this tightening will show up, or we will really get permanently soft landing, like the markets are pricing right now, which is not our view. Our view is like soft landing views can strengthen further, markets can get richer, but at some point in the year, you have to face with the reality that the market may have to swing towards a recessionary territory before it can come back into balance. So Nike Swish, but with a deeper curvature to it. And of course, we have built up a range of indicators to monitor where we are right now. So right now, we are very likely in soft landing. But as I said, some of the leading indicators we are watching are deteriorating, especially financing of consumer, credit growth of the economy. These are leading indicators. It's very difficult to avoid a recession when credit growth is negative. So those are the few factors which we are watching and which make us cautious further into 24 compared to where we are right now. So I'll a couple of comments in China. So we are positive in China. Cyclically, we think control stabilization will start to come into play. There's a lot of policy stimulus being put in now. I was in Asia for 3 weeks, speaking to some of the largest investors focused on these topics. So there is an understanding. I think the policymakers in China have realized it belatedly that property sector will have to stabilize before macro stability can return. But a lot of Chinese, for example, equities, especially in consumer side, AI side, have been penalized a lot due to the macro instability, and which we think will start to unwind because a lot of these companies have nothing to do with the property sector, have clean balance sheets. So there will be better outcomes potentially. But medium term, US-China decoupling remains in place, and then of course potential Trump presidency can take it into another different direction, at least in the short term, with trade wars coming through again. So quite a few things to watch there, especially in the next few months when political noise in the US will rise quite sharply, and may start to have market implications as well, which may be different from the last time Trump came into power. So I'll pause there and see if you have any questions, any thoughts.
Thank you. A lot of questions. I have a lot of questions, but before jumping into some of the more detailed questions, I really would love to get your input on UK. You mentioned about the elections over there and the high possibility of Labour Party winning. What's the outlook for UK? And then Labour, historically, markets have been very scared of Labour Party winning. So is it more downside from here? shall we all try to get out of UK? For those of us who live in London, would love to hear your views on.
Yeah, so I think contrary to consensus, I think UK is so unloved and underweight. I think there is some positive delta there because there is not much difference between Labour policies on economics and what Tories are doing right now. So Labour has become more centrist in their policy, prescriptions. So this is not the Labour of the far left Labour. Firstly, debt is very high, interest rates are high, so doing unconstrained fiscal is not easy anymore. And in fact, if there's one lesson from Liz Truss is that listen to the expert, if you will. So I think that lesson has gone through as we engage with Labour Party as part of our different forums. And I think the positive surprise may come through is that if you look at the new survey data, more than 60% of people think now Brexit is a mistake compared to around 33% a few years ago. So Labour is also giving signs that they may go for a closer relationship with Europe. So that's another positive which may start to come through. Basically, Brexit as a word will be retired, and it's not like we are saying that UK will rejoin EU, but the hard Brexit outcomes will start to ease. You are likely to see more moderation there, and given the geopolitical situation, Europe cannot afford to just pull off UK because of Russia issue and Russia-Ukraine issue. So the geopolitical and the defense situation has already seen stronger, connectivity between Europe and the UK, and that may start to broaden out a little bit as well on the economic policy side. So the hard Brexit outcomes may start to ease as we move further. And the fact is that the electorate is also, the population or electorate is also indicating that they think that Brexit was a mistake. So, and UK is very underweight. The market-wise, it's a value market. So it's done relatively well this year. We think that can potentially, in a relative sense, continue. So we're not as negative on the UK because of these delta changes. It's not like a level shift, but the delta will start to become a bit more positive than historically. And then the idea that Labour is bad for economy, frankly speaking, has been destroyed by Tories. I mean, so
Yes.
it's all relative in that sense. So probably we'll see a bit more stability or compared to the recent past.
A lot of questions have started to come through, but I'll still take 8 more minutes to ask you questions, and then I'll move to the questions on chat. You spoke a lot about politics and geopolitics and elections. And a few, I was at a big conference in Saudi Arabia, and I met this guy who is very involved in global geopolitics. And almost like 6 months ago, he was telling me that when US by mid of this year, US will need to cut rates because of elections. So, and now the market is also saying that rates will be cut, and now that's so how much of Fed's decision making or global economic policy making is driven by political decisions and political events rather than economic data points?
Look, I think the general economic environment is affected by politics, right? So the policies of different political parties are very different. The Fed obviously will never say this, but once the labor market starts to turn, I think they will, as we have been saying, they will pivot and not wait for inflation to go to 2%. And even if you take aside politics out of it, the issue is high debt ratios, i.e., you can start to trigger a massive deleveraging if you don't back off from these high real rates. So in that sense, it aligns up. But really, the indicator is labor market, because that's the labor market cracking also has political implications, if you see my point. And remember that Fed is a dual mandate central bank.
But even on a global basis, like what happened with China or what happened what's now happening with India in terms of the rise of India and the decline of Chinese equities, a lot of people, that is a lot of that asset returns are driven by geopolitics. So when now at your position, when you're advising all of these large pots of capital which have a long-term um, investment horizon, um, now have they started taking geopolitics more into consideration? And then do they feel that they need to incorporate geopolitics as a layer in their analysis of global market returns?
Definitely, I think geopolitics is very important now. It has, but it plays out in different shapes and forms. Markets do struggle to price in geopolitical events in an episodic manner, but the structural themes are starting to get clearer. And then you can see, investors' view on different markets being shaped by where they are, which jurisdictions they are sitting in. So it's here to stay, and that's what we do focus on as well from a medium-term perspective. So U.S.-China decoupling not going anywhere, the risk of trade wars. These are important risk factors to consider. But then you have to see, okay, what is priced in and what is the outcome the markets are pricing in, right? So in China's case, we think extreme outcomes have been priced in. Not to say that the investors want, right? But there is also a change in the policy setup and understanding that macro stability will be needed, for example, in China's case. But certainly, to your point, geopolitical influence on capital flows is as high as you get in the last 20-25 years. And in the short term, it's difficult to, as I said, price in by the markets because they can be episodic. But medium term reshoring, for example, is an important theme. You see FDI flows into ASEAN; they have shot up massively. So it's playing in the background for sure.
And Salman bhai, the last question from my side, and then going to the question from chat. Over the last few years in your webinars, you've always been very appreciative of Chinese economic policy making machinery in terms of their long-term, in terms of their intellectual capital, in terms of their long-term thinking. Then how did they make the recent mistakes? And then what's going on there right now? What do you think led them to make these mistakes? And have they stabilized now? Because you said that you are more positive on China going forward. Where are we on China? And what's the view coming from when you go to Asia and you talk to the institutions over there, what's their view on China? Because I'm assuming that the kind of audience I speak to, they're mostly Western, UK, European, or the US asset managers, and they might have a more negative bias on China compared to Asian investors. So, would love to get some color on what are Asian institutional investors thinking about China.
So I think if you think about what happened with the property sector, the reason why they wanted to clamp down on it was because there was a lot of leverage in that sector. So one can understand why, because if they had waited, it could have been a much bigger problem down the line. I think the issues came through was obviously the COVID policy. The multiple things happened at the same time. So it combined as a quite a big crunch on the economy, and then of course the negative sentiment that came through on the market side. So as I mentioned, there is now a sense that property sector will have to stabilize before domestic demand can take hold. So that's a bit changing. But that said, from an investor perspective, in terms of geographical dimensions of it, yes, it's a very important factor. In Europe, in US, the view on China is different from what you find in Asia because of their geographies. And that's likely to remain the case. So system diversification is likely to be an important force because you had sanctions risk if you're dealing with the US, if you're a middle power, if you will, whilst in China you have other kinds of risks. So it's a question of balancing the risks. It's not an easy situation to be if you are a middle power. And can be exposed to change in narratives and change in policies.
And if I can squeeze in another, any comment in Saudi Arabia in your meetings with investors? Do they ask you about what's happening over there, or did you get a sense of What are global investors thinking about Saudi Arabia?
So obviously the change of reform agenda going through is attracting attention. But again, Saudi Arabia is still seen as an exporter of capital rather than a importer of capital, which is the way I think the flow of capital also is set up as. So it's a question of what are the opportunities which come through, which are not like 10 year, 20 years in. Investors also, some horizons are different for investors. So I think still dominantly seen as exporter of capital, not as an importer of capital.
Got it. Thank you. Now, moving to the questions of the audience, there's a lot of questions from the people on this webinar. The first question, I'm just reading the question, Salman Bhai, and then you can respond to them. The first question is on Pakistan. What are some of the fiscal reforms critical for economic stability and sustainable growth in Pakistan?
Well, it's the same since I joined the industry and started, learning economics. So Pakistan's problems are much more deep-rooted, and increasingly, I think they are a choice rather than it's a sign of constraint. So the economic stability has never been prioritized. You can tell it from the kind of people who start running economics in Pakistan. So it's in some ways it's starting to show that maybe that's the signal you are sending to the rest of the world, that you don't care about it. But I think it's the same issues, which is tax base is narrow. We have got incentives which are being distorted towards real estate sector massively, which is not a productive use of capital. We have got obviously interest groups and rent-seeking behavior across the board in the economy. All economies have rent-seeking, by the way, but not to the extent I've seen in Pakistan. In Pakistan, it's like widespread. So all those things have to be, I think, thought about and implemented in terms of reform if Pakistan is gonna, break through this negative loop of crisis upon crisis, and then dealing with them, and then all that cycle which comes around with that. So it's a question of willingness. I think they can learn from China for sure. China still is growing quite strongly. They've made a huge progress in AI, renewables, despite those macro issues we are talking about. Some parts of China is still progressing very significantly. And they are far, far away and above India in many respects in the value chain, even though there's a lot of excitement about India, but on a level-to-level basis, they are decades ahead of India. So it's a question of, of breaking through those rent-seeking behaviors, focusing on dollar production in terms of your capital deployment, and then moving away from real estate, because real estate is a massive negative force for the country in terms of non-productive use. I mean, you can use real estate productively, right? As well, if you're creating a plant or you're using land or increasing productivity of agricultural land, but not as a store of all kinds of untaxed money. That's happening. It's the worst kept secret in Pakistan. So it's a question of choice now. I feel, rather than now a question of forced, being forced by the environment.
No, indeed. And you started off by saying that getting good economic managers. So I think a lot of people are praying that we don't get the same gentleman again. Moving to the next question. The question says that the Fed is not pausing quantitative tightening despite the pivot announcement. What implications it can have on the liquidity positions across the markets in 2024?
So I think this is an important question from a technical perspective. A lot of in 2020, Ms. Yellen did quite a bit of issuance on T-bills. So a lot of the big fiscal stimulus which came through was financed by T-bills, and those have been rolling over since then. That means you get a heavy source of issuance to roll over that T-bill T-bill funded fiscal, which was done a few years ago. So on top of that, obviously, we have got QT as well. So we are expecting, as the recession becomes a bit more clearer, QT will have to stop. If anything, the markets may create a issue and have an issue, and QT may have to be reprofiled. But if anything, 2024 is, by end of 2024, you should have this end of QT. But there are i.e. two risk factors which can force an earlier, pivot on QT as well. One is if the data deteriorates quite significantly, more so than we are expecting. The other is you have another fiscal, which is then announced by the new president if he or he comes in 50-50 right now. So that can really smash in the face of QT. So like Bank of England did, which is pause QT and reverse it. I think the Fed may have to do that as well. But that's certainly a risk factor you have to watch. That how will the Fed manage QT when they are starting to a position for a cut.
Thank you. The next question, do you see the Fed reducing rates in 2024? Also, S&P was up almost 18.5% in 2023. If rates stay stable, where do you see S&P 500 going in 2024?
So first, I think first few months, we think upside risks to S&P are still there. So you may make new highs in S&P. So, but the risk would be that it becomes a bit more rich versus if the labor market is also cracking, because a lot of these Magnificent Seven included stocks are exposed to the consumer in the US. They are reliant on consumption to continue, iPhones, subscriptions, you name it, right? I mean, there's a consumption element there. So we think that S&P can make new highs, but it is exposed to a significant correction during the course of 24, and that will only reverse if the Fed pivots properly dramatically. So this time around, the reversal in S&P will be dependent on how quickly the Fed pivots. So different to 2023, where the Fed was still hiking and S&P still managed to do well. We think that 2024 you will need the Fed support for gains to be made, because the market is expensive.
So you, essentially, to summarize, you're saying that in the first half, S&P can go higher, and then when the concerns around recession start becoming more clearer, then the markets can come down unless then Fed intervenes in the market.
How dramatically they pivot.
Osama is asking, could you please comment on the interest rate sustainability with regards to high fiscal deficit going forward? He's saying that I understand double line capital is quite vocal, as that might be the next thing to break. Any comments on it?
Yes, so there are issues there because of the financing, as I mentioned, which was carried over from 2020 on T-bill issuance. Interest payments as a percentage of GDP are rising, and next year likely to be higher than defense. So even where, if you look at CBO projections, you're looking at interest payments as a percentage of GDP rising quite significantly. So it's gonna be a tax on the system because of very high debt burdens, and that's where the high debt burden is going to be an important medium-term force, and that's why we think the term premia will have to come back in bond markets. So you have to become upward sloping in the 10-year part, for example, versus the short end. It also means that treasury market accident risks remain high, and then lastly, in this cycle, we're thinking that 10 years only bottom at around 3%, which was the high of the last cycle. So this is again a very important feature of the next medium-term setup we are envisaging, where cash averages above 3% over the next 10 years. Which is meaningfully higher than the last 10 if you exclude 2022. So it will change investment mapping because cash will be a proper opportunity cost. That means discount factors are higher, especially when you're looking at venture capital and other things. So it's that kind of world where you have high average inflation, high average interest rates with rates remaining volatile because of fiscal being so high, debt ratios so high, and then political risk, which messes around with fiscal. So I think this area which your double line is focused on actually is much more severe if Trump presidency comes in.
Thank you. Now, there are a few questions about Pakistan and PSX and the bull run over there, but I'll come to them later just because I want to club some questions on global markets first, and then in the last session, we can just focus on Pakistan. So there's a question that I'm combining two questions. One is that, do you expect ESG-focused investing that has been the key theme of previous years to re-rate going forward, considering the horrible last 2 years? And then there's a question about, what's your view on oil going in 2024? Will Saudi role be in the spotlight with US domestic production at record level? Can we see the market share game to come in play and a price war? So two questions, ESG and oil.
So ESG, I think the issue with ESG has been because all the underlying factor exposures of ESG have been the same as unprofitable tech more widely. It is not just ESG which got punished. Anything which was unprofitable started to get punished. So that was the underlying investment thesis, and then ESG or clean tech was an expression of it, if you will. This is a reminder that fads and fashion do come in, and you have to think about solid investing fundamentals and foundations, especially if you're a longer term horizon. So in terms of ESG, I think it is morphing. A lot of now focuses on impact investing, infrastructure, climate adaptation, mitigation now. I was in Morocco for IMF meetings. That's what the main focus was, how to get funding for key projects. And then you saw that in COP28 as well. I mean, my colleagues were attending that, there's a focus on getting the private-public partnerships going, especially in infrastructure. So those are real projects with real impact and real, KPIs. And the idea is, how do you generate appropriate risk return on capital doing that? So the multilateral agencies will have to probably step in, de-risk some of the deals and the marketplace there. Let's see how we proceed there, but there have been some good steps in that direction, although not enough, nearly enough. So ESG, I think as a theme, is already getting scrutiny from the regulators here in Europe, especially. So it will morph, and potentially a better version will appear, where you have stringent criteria of what ESG integration means rather than just marketing, basically, which is what it was earlier. So I think the fad is gone. Now you will probably see genuine innovation and genuine solution providers start to appear.
Oil prices.
Going forward. So oil prices. I think actually I like oil as a defensive assets in your portfolio as a hedge, given the live wars we have got and the way pricing is. It's only asset class which is pricing in a recession right now. So I think at these levels I am a buyer, because if you are especially risk on in your other parts of your portfolio, because the two wars people are focused on are live wars and hot wars, and you can see, potentially see things getting worse in both of them, and oil is not pricing that in, and it is the key barometer of these two live situations. So, and the question of price wars, I think less so. I think the Saudis or OPEC plus pick up their market share if needed. It's a question of the geopolitics of it as well, and protection of those price barriers. But yes, China's tepid recovery has not helped oil, and that may start to change if domestic demand in China starts to build up a bit. So at these prices, upside risk. If you remember my forecast last year was range bound between 70 and 90, and that's more or less what happened. So you buy at 70, you sell at 90, basically. That's probably still the play. That said, the spike risk to my mind is higher than the market thinks, which is that, given these two live wars, which can change, because this is not a steady state for both of them.
No, thank you. And you have been oracle-like in your forecast on oil over the past 3 years. So I think that range-bound call, people should take note of that. You mentioned the wars, and there's a question that on Russian-Ukraine situation. Any input on that? So there's a question that, do you see this factor will embolden Putin to escalate the war post the elections in Russia? Will this end with redrawing of Ukraine borders and Russia getting a major chunk of the country?
Look, I think things have started to change. Obviously, as you know, there's stalemate going on the military side or on the front lines. I think a lot will depend on U.S. elections, and of course, what is also changing is the funding attitude or from both Europe and U.S. towards Ukraine is changing, as you know from the news flow. So I think for the next few months we are expecting still a hot war, but this. But the funding is obviously a very important factor. If Ukraine doesn't get the funding, then you will probably see changes on the ground as well. And then the US elections. I think both are going to be very important for where this war ends up as. And I think and different scenarios can be charted out. So I've heard about this idea that you may get escalation from Russia side. So I think this is a live situation, and then linking it with oil, probably not priced in. That things can change rapidly on this front, but it is a different situation compared to a year ago now. There's
Russia has the
more.
momentum.
I mean, Russia. I mean, it's a stalemate, right, at the moment. So in that, if stalemate is a momentum with Russia, it depends on how you characterize it, because they have defended whatever they've got quite well, at
Yes.
least from a military perspective. Now the question is, can they defend it from a political perspective? And I think election in U.S., funding for Ukraine are the two key barometers, or are you drivers of that?
There's 14 minutes left for this webinar. There's a lot of questions. We might have to miss some questions. I want to go and focus on the Pakistan-specific questions, but before that, I think this is an important question, so I'm just pitching that in. I'm reading, there's growing talk of de-dollarization, with more economies shifting to non-dollar currencies for trade flows, coupled with diversification of reserves by major central banks in emerging markets. How do you see these developments impacting dollar dominance in global financial system going forward?
Look, I think it's a very slow-moving process, probably not in our lifetime. Just to give you an example, GBP remained reserve currency till the 1970s. In fact, it was Nixon's decision to link commodity prices with dollars, which started to, dollarize the system. U.S. assets markets are very deep, capital markets are very deep and liquid, so there's no substitute as such available right now. China obviously is growing, but China doesn't have an open capital account, so there's always limitations in terms of how much bilateral stuff you can do. So of course, on the margin, the trend is going probably peak dollarization is probably the view rather than de-dollarization, because this can take decades, because the whole system is wired with dollar as the base currency. I mean, just to give you an example, let's say you have a road network where you are doing right-hand side driving or left-hand side driving. It's not easy to switch over overnight, right? So I think that's a good example of that. If you're going to move from right-hand drive to left-hand drive, it will require years and years of planning to do it. So it's the foundational wiring of the system. But peak dollarization is probably I'm comfortable with, but de-dollarization is probably not so much.
Thank you. That was very wise. In your opinion, what is the best asset to invest in 2024 from a US perspective? Is it T-bonds? Is it gold? Is it equities? Where would you put your money if you're living in America? And also, where would you put your money if you were living in Pakistan?
So I think we're looking at intermediate high-grade corporate credit, which is 5% plus yields. So you can lock them up. These are very high-grade, high-quality bonds. 5% last time you got was 20 years ago or whatever, 15 years ago, 18 years ago. Default rate in this segment is very low, even if you get a recession. So reinvestment risk for cash is high. So in equities, I think, yes, you can play the momentum right now, but you'll have to at some point get careful that markets are going to be very expensive and not set up for potential weakness in labor market. So I think that balancing has to take place. So we are changing our tactical asset allocation more frequently now than in the past. So yes, intermediate, intermediate corporate credit is a very interesting opportunity as a cash substitute, if you will. Gold, yes. I mean, gold. Gold has done very well. I think it continues to have structural tailwinds to it. So I think that's a good, especially in Pakistan. I think it's a good diversifier to your PKR assets, and especially given the macro instability there. And then equities, as I said, there is momentum there. And within equities, I like Japan, I like UK equities, which are value, so you may have diversification there, versus what you have been used to in the last 10, 15 years, which has been US dominated.
Thank you. Now, last 10 minutes on Pakistan. Pakistan market is up more than 60%, I think 70% since the trough of May, since IMF came. Is it sustainable?
Look, I think in value terms, Pakistan is still a very cheap market. So that still remains the case. In dollar terms, I think we are just making up for the dollar depreciation right now. But tactically, you can justify the rally because in past cycles, when IMF comes in, it usually, the rallies do get set up. And you can argue they became too cheap because they were not only falling in rupee dollar terms, but also massively in rupee terms. So all you're doing is now unwind the dollar side of things. But is this a structural break in Pakistan? No. I mean, Pakistan still has the same vulnerabilities, and it will remain structurally a value market or a value trap, more likely.
Unless they do the reforms.
Unless they do the reforms, yes, and there are good ways to do that, and now known and conquered ideas about it. I think people ask, "Oh, this is very complicated." The complication is that you find the implementation complicated. The concept and the ideas are not complicated, and others have done it as well. It's not like, oh, you're the first one who's going to do this. So it's collective, I think, will, which is needed. But yes, this I see it as a tactical rally. I can't tell the peak, but all you've done is unwound the dollar depreciation. These are good businesses, don't get me wrong. They're very good companies, as Ali, as you share with us. But this is a value trap market, and I think the relevant examples are Russia. I mean, Russia has traded like a value market for years and years. So that's similar.
Yes, no, indeed, you're totally right that if you adjust for dollar and inflation, if we get back to the level of 2018, Pakistani stock index would be more than 100,000
Exactly.
level. So that means there's another 55% upside just to get to the level of 2018 in dollar terms. So there's a lot of upside, and it is just catch up of valuation or catch up of asset pricing to real terms.
Some more stability than before, yeah.
With more stability. And Salman Bhai and I attended meetings with State Department in London, after which it was clear that IMF program will come and this such a rally could happen. There's another part of the question, somebody else's question, which is on the challenges of Pakistan in terms of chronic twin deficits and the need for foreign funding. It's a long question. I'll just focus on the last part of his question, where he's asking, how do you see Pakistani economy navigating without IMF and any bilateral help? So if there's no IMF and if there's no money coming in from Saudi or China, what's the future of Pakistan in that case?
Oh, you default. I mean, it's just
easy.
I mean, that's the easy answer. We are not self-sufficient economically speaking, and there are good reasons why we are not, because we have not prioritized it. We are a consumption-based economy, which wants to consume. Our elites wants to consume, and that's what happens when you are 100% consumption-based, rent-seeking economy. You don't get economic resilience. Economic resilience needs sacrifices, but it pays multiple times over once you have that underlying stability, like you see in India and you see in China as well. But we are on these crutches because we just want to consume.
No, absolutely. But for the audience, I'll just throw a thing over there. That I do think that money will flow in from countries like Saudi Arabia, and I think privatization will happen, and Saudi investments will come. And as some of you might know, that I'm quite actively involved in Saudi Arabia. KTrade has a local office there. We are talking to some of the funds like PIF, etc., who are looking at Pakistan. So I think the interest is real, and the chances of investment coming in are fairly high. So I wouldn't be that skeptical. Salman bhai, in the last 5 minutes, you spoke about the needs for reform in Pakistan. So there's a question that what are the top 3 policy changes which you think Pakistan needs to create a more favorable investment climate?
So I think the first one is that we have to go through a proper assessment of industrial policy. We have to basically prioritize industries which are able to produce dollars and deprioritize and penalize industries who are consuming dollars a lot. The way to do that is through currencies. Currency depreciation is a mechanism to do that, but in Pakistan, that signal clearly doesn't go through, so it requires policy changes because of distortions created by by some of our fiscal policies, especially. That's critical because we have to build long-term trend growth and to create that export capacity. It has to be seriously drawn in terms of policy incentives, especially for dollar production. There are lessons to be learned, right? That it can't just be textiles. It has to be broadened out over different industries. But it is important that Pakistan starts to prioritize production and savings rather than consumption. I think that's a very important underlying foundation we have to build. It also means that we have to have KPIs like reserves that that like India did after 1990s, that you keep on building reserve resilience, and everybody collectively, especially the elites, agree that this is an important goal, if you will. Second one is, I think, got to do with is linked with the first. I know this, you may have heard it many times, but it is the right policy. You have to broaden your tax base, and we cannot put on taxes on the few sectors which are already paying taxes. It has to be broadened properly. The risk incentives, especially in the agriculture sector, for example, have to be tackled. There's a lot of untapped capital and resources sitting there which are misused, which need to be redeployed. And then thirdly, we need political stability, because to be able to deal with your external partners, you need baseline political stability. And now that is uncontrollable in some certain respects. I'm not saying this is a policy, but that is, again, a consensus our elite will have to build. And when I say elite, it's not just the government or state elite. Even the business elite have to build together that this stability is needed to be able to deal with our external partners. If you're going to bring FDI, if you're going to bring do long-term trade deals, nobody wants to deal with a country which is unstable all the time. So it's not a policy, but that's we should not underestimate how important political stability is for economic stability and vice versa.
Absolutely. And the last question, we have 2 more minutes, but perhaps the most relevant questions, as you know, a lot of the people in this audience are invested in or work in startup space. What does the global liquidity condition means for funding environment for Pakistani startups?
Look, guys,
Will it
I think,
improve or will it be like last?
yeah, as you know, I've been a skeptic over the last few years, but that is my void into myself, because my investing horizon is a bit longer. So fads and themes are something, I'm trained to pick, basically. Now, the question for us is, I think now we are entering that phase where real things can happen. So it's very dangerous when you start raising a lot of funds on the back of presentations and PowerPoints. I think that's usually not good for people who are raising it, and certainly not good for people who are giving the capital. And it is actually pretty bad for the people who take the capital, because obviously it hangs over their head, right? If you've done it at the wrong valuation levels. So I think there are genuine opportunities where the market is still open for VCs. So if you're solving a genuine problem which has, economic potential and cash flow coming in nearer in the time, you will get attention. But if you're saying, I want to solve, developing country problems using Western country problems, that's not how world works. I mean, for example, I'm just giving an example. The delivery services in the West, it makes sense because I don't have people working for me. The natural setup is different. Now you're applying that to Pakistan. Obviously, you're not going to get any, any discount factors. A different market, spending behaviors are different. So I think I don't mind copying the West ideas. But I think the main thing is that we have to do it in a way which is cost effective, which is possible now in Pakistan because dollar is so, depreciation has massively mean Pakistan is very, very competitive. And I think we need to start doing things at scale. So, the freelance is a good starting step, but, we need to start thinking about building a service providers in thousands and organized, because big companies do not work with freelancers. They work with organized companies, right? Because they have to mitigate their risk. And Pakistan is very competitive now compared to India, for example, where I know the numbers is 1/3 now in some cases. So I think it's time to start thinking about ideas which can stand the test of time, and that's where you get the right valuations. You will get the capital. You will get the the multiples. But the world is not going to come back to, oh, this is my presentation, this is very fancy, and I have 5 t-shirts of the same color, and I want capital. That's not going to happen anymore.
So time for easy money is gone, but I think another important point which you made is the need for Pakistan to move up from freelancer, because I keep on hearing that, or we have been saying for a while, that Pakistan's strength is the freelance tech community, which is huge. But I suppose with AI and with ChatGPT, now you don't need low quality engineers because computers can write that code, and you need to move and migrate to an organized tech sector. And perhaps your LUMS class fellow and your Cambridge class fellow, who is now the IT minister, can listen to some of the suggestions which you.
Yeah, I hope so, because obviously I spent a lot of time with him in Cambridge. But things are changing in the sense, like to your point, now with cloud setup, AI, the risk anybody takes with Pakistan is much lower because the whole data sits somewhere else. But if you're thinking, oh, this is a freelance and I can do these couple of small things, that's not gonna cut it anymore. We need to organize, and we are very competitive. And that's the policy environment has to obviously incentivize that, right, as well. And this is the time to do it.
Great. Thank you so much, Dr. Salman. It was a pleasure talking to you as always, and
thank you
for your insights and all the advice which you gave us.
Thank you, Ali. Thank you, Ale. Thank you very much.
Hafiz.
Hafiz.